The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettlebar along with Accunet Mortgages and Accunet Realty Advisors owner Brian Wickert and licensed millennial loan consultant David Wickert. If you have a question or a comment, you can reach us by calling or texting the Accunet Mortgage talk and text line at 414-799-1620. Some topics of conversation today. The Fed raising their interest rates once again on Wednesday as expected. So that pushes the prime rate to 4.25%, Brian.
Yeah, that's exactly what happened. And this is probably like the most widely anticipated Fed rate move, telegraphed. Everybody knew it was going to happen. And yet, despite that move in the short-term rate and prime rates and the Fed fund rates, guess what happened to long-term 30-year fixed rates?
Stayed the same, went down?
Up or down? They went down. Totally counterintuitive. They went down. So we're going to take a stab at explaining why that is. But let's also just do a quick little historical review of the prime rate. For you and David, I don't know if you cheated, David, and looked at my answer.
I did not cheat.
Did not cheat. Okay. What the prime rate, the lowest the prime rate has been in modern history is 3.25%. What year do you think it went down to 3.25%? When did the Fed push it down?
Okay, I did cheat, but
okay, Steve, do you have any guess there?
3.25%. I'm going to say within the last three.
Think of the crisis.
Okay. Well, let's see. That really kicked into gear 2009.
You are
2012.
No, it was 2009. So the Fed ratcheted the rate. The Fed funds rate is the overnight bank rate that banks charge each other to lend money to each other. And so the Fed pushed that down to 0, which then caused the prime rate that you and I get to pay on things like, home equity lines of credit, credit cards, stuff like that, down to 3.25%. That happened in December of 2008. So let's call it 2009. And it stayed there for 7 years. Okay, 7 long years. Two other interesting prime rate trivia questions for the audience. What do you think the prime rate was 16 months before it dropped to that all-time low of 3.25%? So 16 months prior, David, your guess.
I'm going to 4.5.
Steve?
4.75.
How's about 8.25%?
Oh,
8.25% was the prime rate in September of 2007.
So they quickly
they dropped it like
the prime rate.
Well, actually, it took them all year. All right. So now the last time that the prime rate was in the 4s was November of 2008. So they got it down from 8.25% down to 4 in about a year. Mm-hmm. All right. So the 30-year fixed rate. So remember, right now the prime rate, just to review, is 4.25%, and David just did the numbers for us. We can offer a 3.875 30-year fixed rate, lower than the prime rate, okay, with just $1,600 in total loan costs if you have 25% equity and all the other right stuff. The APR is probably 3.92. Okay. So right now we got prime rate at 4.25%, 30-year fixed rate at APR 3.91. The last time...
That's upside down.
That's right.
Yeah.
The last time that we had a 4 prime rate, tell me what you think the 30-year fixed was. Dave?
6.
Steve?
7.
6.09.
Okay.
So what is going on here? What is going on? All right, so just to kind of review, the Fed's job is to keep everybody employed. Check that one off.
Yeah.
Right, because we're at a 4.3% unemployment rate. You don't think we're fully employed? I think we're fully employed.
Okay.
We're close. And then price stability, meaning let's keep inflation tamped down. Their target is they would like inflation to be at 2%. And the problem, what actually happened, which was really weird this week, 30-year fixed rates got lower before the Fed announcement because of the latest inflation report.
Yes.
The latest inflation report, David, put the inflation year over year at
1.7, and they were expecting 1.9.
Aha. So we've got low inflation.
Not fast enough inflation.
Not fast enough inflation. Okay. So the bottom line is that we've got a weird thing going on, and the question that we're going to answer after this first break is, what did the Fed do, and what to get long-term mortgage rates down to where they are, under 4? What was the mechanism that they used? Because they already had that prime rate as low as they could take it. They had the Fed funds rate at 0. What did they do to get long-term mortgage rates down, and what are they going to stop doing? And they've announced it. This was not widely covered. They announced it on Wednesday. We'll cover that when we come back.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
WTMJ's classic free ride is out of our garage and ready to head into yours. You can register online to win the 1968 Valenti Oldsmobile 442 convertible by heading over to WTMJ.com. It's sponsored by Prescient Financial Solutions with Northwestern Mutual. And don't forget to text the word RIDE to 414-799-1620 to check out a photo gallery of your next car. Brian Wickert is with us. David Wickert is with us. And we're now focusing in on the mechanism the Fed may use here to get long-term rates down again for mortgages.
Oh, good guess. They're actually going to unwind it. They're going to reverse it. All right. So do you remember what is that famous cruise ship called that's docked in San Diego or Los Angeles that's named after a queen?
Queen Mary.
No, is it the Queen Mary? I thought it was
have
Queen
no
Elizabeth.
idea.
All right, QE. All right, I was going for Queen Elizabeth. All right.
Oh, the QE,
So the
yeah.
thing that the Fed used, the mechanism that the Fed used, they had already dialed the rates down to 0 for the Fed funds rate, and still mortgage rates were at 6. And so they said, how can we push mortgage rates down even more? And they said, we know, we'll start buying mortgages. We'll increase the demand for mortgages, and that'll push the rates down. We'll have this insatiable appetite. So they had QE1, QE2, and then I think QE3. And so the Federal Reserve, now don't think about this too long or your head will explode. There was literally a guy, I saw a news story on it, at the Federal Reserve in New York, who would invent new money by typing a few keystrokes on a computer screen, and they were buying $83 billion with a B dollars worth of mortgages and 10-year Treasury notes a month for a long time. All the way, David, you looked it up
Until October of 2014 is when they stopped.
Okay, and this massive buying of mortgages lowered rates to the point where they got down to about 3.875. Okay, which is great. That helped people buy more houses, and that stimulated economic activity and made home prices go up and all kinds of good things. All right, so here's the deal. On Wednesday, the Fed said, okay, here's our game plan. Even when we stopped buying new mortgages back in 2014, they still have been buying how many billion a month?
40 billion worth of mortgages and treasuries a month.
Because as people...
Which I'm calling implicit QE.
Okay.
Explicit QE was we're buying 80 billion, and implicit is reinvesting the dividends at 40 billion a pop.
Meaning as people make their mortgage payments every month, part of that's principal. So, and the interest, they're taking that money and they're buying more. So we've really been on this dole, if you will, this long-term mortgage interest rate stimulus, even since they officially stopped. Okay,
Right.
So now they came out and they said, you know what, sometime soon, they didn't give us an exact date, we're going to start trimming that back. Instead of reinvesting $40 billion a month in mortgages, we're going to trim that back to 30. And then every 3 months, we're going to keep trimming that back and trimming that back to the point where at some point, maybe in 18 months, they're not going to be reinvesting anything. Okay, and so they're going to allow their mortgage portfolio to shrink, meaning, you said it before,
It's classic economics. It's when the demand goes away, rates will rise because you have to offer a little bit more in rate in order to get the same kind of appetite from the marketplace. So a big appetite is about to gradually walk away from the mortgage market.
Right. Your biggest lunch customer, who I got a hankering for that mortgage stuff, he's going to start pushing back from the table. All right. The other really interesting thing is the Fed came right out in writing and told everybody, we're going to raise short-term rates another quarter. That means everybody's home equity line, if the Fed follows through in their promises, is going to go up another quarter point by the end of this year. And they said, and we want to do it 3 more times in 2018. So by the end of 2018, the prime rate should be at 5.25.
Yikes.
If you've got a home equity line of credit, if you've got a big balance on your credit card, those things are tied to prime. Those are adjustable rate mortgages, folks. We were lulled into thinking, oh, yeah.
For 7 years, it was at 0.
Because for 7 years, the prime rate stayed steady. It's now up from 3.25 to 4.25. If the Fed keeps up on their promises, it's going to 5.25. Meanwhile, fixed rate rates are down. We're at the perfect time to put your home equity line balance or adjustable rate credit card debt, if you're carrying a bunch, together with your existing first mortgage on a low fixed rate. And you can do that. Guess where? Accunet.com. All right, when we come back, I'm going to tell you the story about how you can get in trouble, how we had a buyer really get himself into big trouble by not allowing us to verify his assets before he wrote that offer on the house. We'll give you that story when we come back.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, summer vacation is here, and it's time to plan some summertime fun. So from Kenosha to Hayward Lakes, you can let John McCura help you out with some of the can't-miss summer events around the state during this week's edition of Travel Wisconsin. Catch it at a special time tonight at 8 o'clock right here on WTMJ. So let's jump to this situation where you have a home buyer who doesn't get a rock-solid pre-approval and then runs into a jam because they can't document the money needed for the down payment.
Yep, and
is this really a conversation about large deposits?
This is really a conversation about large deposit, and I think hubris, somebody being overconfident, because this particular borrower makes a lot of money, $50,000 a month.
Does he need a friend?
Yeah.
Okay.
He needs a drinking buddy, David.
Okay, that's fine.
Okay, and so you know, and I think people sometimes in that income bracket are like, I don't need, I have money.
The rules don't apply to me.
Blah, blah, blah. And so he doesn't let us verify anything but his credit, okay? And so as he's begrudgingly giving us his asset statements after the purchase is consummated or after the offer is signed, we start getting in papers or asset accounts, bank accounts, and investment accounts where there are large deposits. So the rule in modern mortgage lending is if the deposit is greater than 50% of the person's monthly income, gross monthly income, we have to document in writing and prove with, copies of checks or whatever, where those large deposits come from. So, he gives us statement number 1. It's got some large deposits. So we ask him for the corroborating evidence of where did that come from. He gives us another statement. Guess what? That second statement has large deposits on it.
Huh.
This is like whack-a-mole.
Yeah.
Okay? And then we say, well, where did that large deposit come from? He gives us a third statement. Guess what that has on it?
Large deposits.
Large deposits.
I'm sensing a theme.
So we're like torturing the guy, but he's like and griping the whole time to the point where now it's Friday, yesterday or 2 days ago. The transaction is supposed to close this coming Tuesday, and he is still dragging his feet on giving us the last pieces of evidence we need. By the way, one of them was a gift from his girlfriend. He classified it as a repayment of a debt from his girlfriend. Do you think we could use that money, David?
No.
No, because in order for that to happen, they would have to be cohabitating in order to call it a gift. Okay. Otherwise, if it's a girlfriend or anybody who's relative, let me say it this way, relatives can give home buyers gifts, and that's a legitimate source of down payment. If people are living together, in a relationship and they just don't happen to be married, that's okay too, but then we got to prove that the donor of the gift is in fact living with the home buyer currently. That was not the case, so we now have to exclude this $28,000 that he got from his girlfriend. Can't use that.
Yeah.
Now we're scrambling to show that he transferred funds from yet another account to his bank account.
Hopefully with no large deposits.
And he's digging at his heels. So I had to have the stern conversation, mano a mano, and say, look, we got two choices. If you don't want to give us these last two pieces of document because we feel we're being too intrusive, that's cool. I'll write you a denial letter today. Mm-hmm. Or you can work with us one more time to get what we need. And guess what? He came to his senses. He got us what we needed, and we'll be closing on Tuesday.
Lovely.
So the whole point of that, folks, is let us do that homework pretty please up front. Please let us do that up front because it was nothing but anxiety. You know, both real estate agents, you know, their hair was on fire. The seller's worried. Let us do that asset documentation up front. All right, when we come back, I'm going to tell you the fastest selling municipalities and the slowest in May in southeastern Wisconsin when we come back.
Expert advice on buying a home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And happy Father's Day to all the fathers this morning. It's 10:35. We're back with Brian Wickert and David Wickert here on the Accunet Mortgage and Realty Show on 620 WTMJ. So we're now focusing in on which municipalities had some of the fastest home sales in May.
Yep, and let's kind of remind everybody, we did cover this last week, but it has to do with home sale prices as well. This is for May. Homes selling between a price of $150 and $169.9 in the 5-county Milwaukee metro area took, I know you don't believe these numbers, but I've double verified them. On average, 1.6 months to sell. That's like 45 days, 46 days. Okay. If you're between $170,000 and $249.9, it got quicker. Only about 35 days to sell. And when I say sell, I mean from the time it was first listed to the time they got the accepted offer. That is the period that we're measuring. If you go up to $250 to $299.9, it gets a little longer, 43 days. When you go from $300 to $349.9, it jumps to 66 days, a little over 2 months. If you go from $350 to $499.9, it goes to just under 90 days. So you get the pattern here. More expensive homes take longer to sell. If you're above $450 all the way up to $750, that's 4 months. You get over $750, and it's taken 6 months on average to sell. All right, so there's kind of your basic numbers.
I'm just of the opinion that if you lopped off, and maybe we'll never be able to do this, if you lopped off the 20% that took the longest, it would shorten up that
the
period.
Average.
Yeah.
So you're just saying this is getting, the average is getting skewed by the dogs.
Maybe.
All right, so let's talk about the fastest before we get to the slowest. So the fastest selling municipalities.
Can I guess?
Okay. Well, I'm going to start with number 10. I'm going to do the countdown.
Oh, okay. I'll wait for number 1.
You wait for the last 3 or 4. Okay. Cudahy, that was 43 days. Fox Point, 42 days. Pewaukee, 41 days. In 7th place, Lisbon, 38 days. Sussex at 37. Greendale at 35 days. New Berlin, 33 days. By the way, you can always tell when somebody's from out of town because they say New Berlin. All right, now we're down to the last 3. You're never going to get this one. Saukville, 30 days. There were 2 municipalities in May, and I combined, by the way, for this exercise, condos and single-family detached, just to be fair. What were the 2 fastest selling municipalities, Dave?
I have no idea.
Come on. You live really close to one of them.
Wauwatosa.
Number 1, Wauwatosa, and it hasn't been in
Tosa.
the number 1 spot. Yep, Tosa for a long time. That was 27 days. And
Mequon.
good guess. Shorewood was in 2nd place at 29 days. Yeah. All right, now the slowest selling, my hometown.
It's Muskego.
Yeah, 79 days. Oconomowoc, 80 days. Heartland, 82. Richfield, 87 days. Mequon, somebody guessed that, 93 days.
Ugh, all right.
Racine, 104. Waterford, 108 days. Burlington, 122. The town of Merton, where I live, 126 days. And Delafield, 161. What do you think is the most common? You know, you think about Oconomowoc.
More expensive houses.
Yeah, right. The only ones that wouldn't be in that category would be Racine, Waterford, Burlington, maybe Muskego, although Muskego's got some really nice homes. So not every home. Hey, so I have a home buyer who was nervous because he had only gotten 1 offer in 5 days. Okay, but no,
He
this
was
was
expecting the deluge of offers.
by the way, the average of all municipalities, this is with home sales of 10 or more sales. I should cover that too. I eliminated municipalities that had 9 or fewer sales.
Okay.
The average for the whole Metro 5-county area was 2.3 months or 68 days. So, calm down. If you're a seller and you don't have 6 offers on the first day, that's okay. That's normal. All right? But if you do put your house in top condition.
That means if you list it today on that average, you're going to get your accepted offer like the 1st of September.
That's kind of unsettling. I mean, anytime you go to sell a house, you'd think that you should get, especially with all the stories that we tell, and you hear from the neighbors.
This is why I think the dogs are skewing the numbers.
But aren't the fast ones skewing the numbers too?
Yeah, but that's more representative of good homes going quick.
All right, so maybe what I'll do for next week's show is dig into like one municipality.
If you can lop off okay.
And see if we can, fine tune, do a little more sophisticated statistical analysis. All right. When we come back from this next break, I'm going to true confessions. I had the pen uncapped. I had the checkbook out. I almost wrote, and I was glad to do it, the first $1,000 check on a rock solid pre-approval. Almost. I'm going to tell you the story of why I was ready to write that $1,000 check to the seller and what the latest is when we come back.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Composer Justin Hurwitz now proudly sports 2 Academy Awards for his musical works in La La Land. Gene Miller goes one-on-one with the Nicolet High School alum to reflect on that Memorial Night at the Oscars. Plus, they discuss the film's very unique showing next weekend at the Riverside Theater. It's all coming up at 11 o'clock this morning on WTMJ Conversations. We're in the midst of the Accunet Mortgage and Realty Show here on WTMJ, and Brian Wickert's going to explain how he almost wrote a $1,000 check on that rock-solid pre-approval guarantee.
That's right. So just to remind everybody, we don't know of any other lender that's doing this. So if we verify a person's credit, income, and down payment, we're writing our rock-solid guaranteed pre-approval letters that with a guarantee that says if we made a mistake and we can't make good on our rock-solid pre-approval letter, we will write the buyer a $1,000 check and we'll write the seller a $1,000 check. So we issued a rock-solid pre-approval letter for a buyer, putting 3% down. And this goes back to the theme of gifts again that we started out the show with, or mentioned anyway. And this buyer was getting a gift from his father-in-law. So, husband and wife, and the wife's dad was giving him a gift, and actually did give them the gift. But another requirement whenever there's a gift is that the donor and the receiver, the buyer, have to sign a gift letter that says, this is a gift, it's not a loan, it doesn't have to be paid back. Well, what happened was we issued the rock-solid pre-approval letter, and we didn't have the gift letter because that's never been a problem before in the 2 years we've been doing the rock-solid pre-approval program. But what happened was the father-in-law decided he didn't like the house. And so even though he had given the money, he was refusing to sign the gift letter. So here we are again, late last week. That's the only thing we need to approve this loan. But because we had not listed it on the rock-solid pre-approval letter, and by the way, the reason that the sellers accepted this offer with just 3% down was because of our rock-solid guaranteed pre-approval letter. I was hanging out there. It's like, yeah, you know what? Had we listed, now this is a good question. I asked the listing agent this question. Had we put as a condition on our rock-solid pre-approval that it was subject to receipt of a gift letter, would that really have prevented your seller from accepting the offer? And of course she claimed, well, of course it would have. But what we are now going to do going forward is, if we haven't gotten a gift letter, if the situation involves a gift, we're going to say that one of our conditions is receipt of a gift letter. Now, is this probably ever going to come up again in the history of Accunet? It's super rare.
And awkward.
And awkward, right. father-in-law.
Dad, I want to buy this house. No.
So I was ready to write the check out for $1,000 to the seller. And then all of a sudden our buyer decided, you know what? I'm going to take the money out of my IRA.
Oh.
Okay. And substitute that money since father-in-law won't sign the gift letter, which makes that money poison. So, I mean, think about that. Even though we had the money in the checking account from the father, it's not usable to any lender until the gift letter is signed.
Yeah.
So we think we are going to be okay. We just got that documentation on Friday, and so we're going to escape that. But I was almost kind of happy in a way, David, to write out the check for $1,000 just to prove that I'd do it.
Sure.
To the marketplace and say, hey.
Chief Honesty Officer, no kidding.
Well, yeah. I mean, because that is exactly what we want people to have, that feeling that I can rely on this. So very odd circumstances that have never come up. I don't know. We've got to have issued over 1,000 rock-solid pre-approval letters with no incident. But I was willing to make good on it. And
they're going to have an awkward Father's Day, I can tell you that.
That is a good point. All right, when we come back from this last break in the show, I'm going to tell you about my latest in my wayward and difficult home remodeling / flipping project of my niece's house up in Stevens Point when we come back.
Right here on the Accunet Mortgage and Realty Show. If you have a question for David or Brian, you can call or text it in on the Accunet Mortgage talk and text line at 414-799-1620.
Don't just find a house, find your home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And David Wickert, as we now get an update on Brian's home remodel flip project.
Yeah, just as a quick reminder, so one of my nieces owns a property in the Stevens Point area that was a rental. It used to be their primary residence, then they moved to another city, rented it out. That went great until the renters moved out, and they rented it for like 3 or 4 years, and the place was trashed. It's a 100-year-old house. So we got bids. The contractor said, hey, I can fix up the inside for $35,000. At the end of that project, he said, I really meant $55,000. And we kind of settled on $45,000. But then that wasn't all. The inside was great. We got an accepted offer right away because it's in a great location. And the buyers then had an inspection done, and we had an inspection done back in the fall of 16. Discovered one basement problem that we fixed, but the new inspection found some other basement problems.
That guy had two eyes.
We must have had the one-eyed home inspector the first time around. And then also called out, it's a metal roof, and our inspector back in September didn't catch it, but there were a couple holes in the metal roof. And so then all of a sudden it was going the wrong way, right? Like they actually got out. They threw the flag on defects and said, we're out. All right, so I'm now looking at it and I go, okay, so repaired the roof, $2,800. Fixed the basement stuff, $6,000. Ooh, also the garage door and blah, 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 there's another $4,000. Okay, roof, garage door, side door.
You're not too good at this real estate empire thing.
I'm kind of going to lose money.
Yeah.
Okay. And so the lesson there is we could have lost, if I would have helped her just avoid the short sale, I could have given my niece $15,000 last year. And she could have sold the place for $60,000, paid off the $75,000 loan. But now this was the long way of probably losing about $15,000.
Great.
All right. So I'm not a big fan of flipping. It's not as easy as it looks, folks.
On TV.
And I guess the older the house, the more problems that there are going to be. Okay, so that's my little flipping story gone bad. Now, let's kind of review. We are living in an unusual time.
Twilight Zone
time where the 30-year fixed rate, David, is at Accunet.
3.99 with zero closing costs.
If you have 25% equity and all the other right stuff, or 3.875 with $1,600 to cost. 15-year fixed, I'm going to guess 3.25 with maybe $500 in closing costs.
Correct.
The APR on that is
3.29.
3.29. Okay. You got that. So long-term mortgage rates that start with the number 3. And you've got the prime rate which is what is used to set the rate on home equity lines of credit, credit cards, is at 4.25%.
I saw a statistic that for every 0.25% hike in the Fed rate, credit card debt nationwide goes up by $1.6 billion.
You mean the monthly payments?
Correct.
Right, because
cost of
if
the
you
borrowed
got
money.
credit cards, plus you factor in home prices are up. We've talked about that this year. It's a hot real estate market. We are in this unique time period. Oh, by the way, the Federal Reserve gave us insider trading, the kind of insider information that if you had it on stocks and traded on it, you'd go to prison. Okay. But they've come right out and told the world, we're going to raise the prime rate another quarter this year and 3 more times next year. All right. So you are armed with lots of really good information.
Near illegal information.
Nearly illegal information. And the opportunity is to take any variable rate debt that you have, large amounts on credit cards that you're not going to end up paying off. If you've got a balance on your home equity line of credit, at least take a look at putting that together with your existing first mortgage into a new fixed rate mortgage.
The way I've started to describe this on the phone is if you have a home equity line of credit that you use to remodel your kitchen or maybe try to flip a house, and you've yet to pay that off, as the prime rate continues to go up, your home kitchen remodel continues to get more and more expensive.
That's right. That's right. So, it's an opportune time. If you want to find out how much you can save, what the numbers are, we make it extremely easy. Click on the blue button at Accunet.com or go to Accunet.com and you'll find our phone number there. You can call in. We've got loan consultants on staff 9 in the morning until about 6 at night. So you can talk to somebody over the phone. We can give you numbers online. You can even look at David's computer screen while we're cooking the lunch, while we're putting the numbers together. It's really cool technology. It's easy to use, and it makes it very easy to make a decision on which, combination of interest rate, loan term. One of the reasons why people hesitate to refinance is they don't want to reset the rate clock back out to 30 years. Not a problem at Accunet. David, what loan terms can we offer?
Anything from 10 to 30 years.
That's right.
You want that 22-year mortgage?
I got it.
I got that for you.
We got 22, whatever. And cutting off just 2 years. I mean, there's another reason to refinance right now. Home values are up. Maybe you bought your house 2 or 3 years ago and you're paying monthly PMI. Wow. Home values up. Maybe you've got 20% equity. Even if you don't, we offer loans with less than 20% equity and no monthly PMI. That can save you a lot of money. And if we can reduce your loan term by just a couple of years, that can save you a ton of interest over the remaining life of the loan. Next week, we've got a few economic things on the calendar, but the opportunity is there right now, since long-term rates are down, to click on that blue button at Accunet.com. That's ACCUNET.com. You can also get started with your rock-solid, guaranteed pre-approval to buy. That's all we've got time for this week, Steve. We'll see you back here same time next week.
Sounds good. And coming up here, Doug Russell joins us with a live update from Erin Hills as Colleen Boland joins us from the WTMJ 24-hour newsroom next.